So how does this broad overvaluation of AI stocks compare to the dot-com bubble? Well, in the words of our analyst, the internet boom brought huge excitement for tech companies, especially those ending in .com. At first, investors were so hyped about this new tech wave that they threw traditional investing rules out the window, betting everything on the next big thing. Stories of incredible stock profits and people getting rich overnight from tech shares fueled FOMO, or a fear of missing out. This, of course, caused everyone else to jump on the bandwagon, sending stock prices sky high. During that time, it was a brand new technology that caused company stock prices to soar, much like what's happening today with semiconductor firms including Nvidia and Supermicro. Notably, Supermicro recently experienced a pullback of around 25%, signaling a potential cautionary tale and hinting at substantial future price declines. Now, for comparison's sake, here's a few articles from the dot-com bubble that our analyst flagged as a comparison for what's going on today. Dell's rise of more than 200% in share price helped it outperform its competitors. By comparison, Compaq stock rose 90% during the year and Gateway climbed 36%. Investors who held shares in troubled hardware makers Apple Computer and Silicon Graphics were left holding the bag at the end of the year. Shares of Apple dropped about 25% by year's end, while SGI shares fell more than 50%. A number of notable internet companies outperformed the Nasdaq by leaps and bounds this year. America Online, AOL, jumped roughly 146% during the year, and Yahoo soared over 500%. However, we all know how this story turned out. Reality set in as investors began to realize many of these companies were not profitable or even generating revenue in some cases. Many didn't even have a real plan beyond just having a fancy website. The bubble inevitably popped in 2000 and the tech craze came crashing down, leaving investors ravaged. And just to show you how insane this time period was, here's a visual of the PE ratios for many of these companies at the time. In hindsight, it was clear these were significantly overvalued, but it's difficult to be able to see that while the bubble is forming before it actually bursts. After the tech bubble burst, tons of companies found themselves in a bankruptcy situation, including well-known names like AltaVista, Broadcast.com, eToys, and even Netscape. Meanwhile, the companies that managed to stay afloat didn't see their valuations recover to previous levels for 10 to 15 years or more. Can you imagine that? You buy a stock at the wrong time, and assuming the company even stays afloat after the bubble burst, it takes you a decade or even longer to see the share price come back up to the price that you bought in at. If you take a look at Cisco stock, which was flagged by our analyst, you can see how investors got locked in and had to either take massive losses or ride it out for nearly 20 years. In fact, Cisco stock has never actually reached the price that it was trading at during the peak of the dot-com bubble since then. Now, stocks like Oracle and Microsoft had a similar situation play out, but these did eventually surpass their peak of the bubble share price about 2 decades later. This chart here shows the average 20-year annualized returns by asset class from 1992 to 2011 compared to the average investor. During that time period, the average investor had an annualized return of 2.1%. Meanwhile, inflation came in at 2.6%, so they actually lost money over that 2-decade period. Our analyst also pointed out that we've seen similar bubbles appear in the market since then, including the biotech bubble, the 3D printing craze, the cannabis gold rush, and most recently, the electric vehicle bubble. What's fascinating is they all share a common thread, which is a groundbreaking or disruptive technology. And here's how all of these cycles have played out. First, a new game-changing technology hits the scene. After that, early investors jump in, betting big on the companies leading the charge. And these early bets start paying off with returns returns that beat the market average. Then come the buzzwords, the headlines, and the success stories, drawing even more people to invest in anything related to the new technology. And at this point, the FOMO, or fear of missing out, hits, and investors begin to skip their due diligence and invest no matter what. Confidence skyrockets, and across the board, everybody starts to think this time is different. But inevitably, every single time, the mood shifts. Maybe it's the overall economy or a major player in the industry that misses an earnings target. All it takes is one event for the bubble to burst, and very few are going to end up selling at the top.